Okay. Welcome everybody. Hope you're surviving the snow that we're having right now. And we're just gonna give it a few minutes, let everyone have a chance to come on in, and then we'll get into it. Our first time home buyers seminar. We did one of these a couple times last year, and it was really good success, good turnout. We're excited to do it one more time. We got a slew of educated people here to educate you guys on all fronts. So we'll maybe give it 3-4 minutes, let people come on in, and then we'll get started. Okay, we'll give it one more minute just to get everyone on board, and then we'll get started.
Amazing.
Okay, let's get it going now. I guess we're just waiting for Rami to come on board, but he's not until later on in the presentation. So hopefully he will be on by then. I know he's having some computer issues right now. Anyways, so welcome everybody. Thank you so much for joining us for our first time homebuyers seminar, or webinar, should I say. We've got William from CMHC, Evan Shapiro for the legal perspective, Rami from TD to talk about mortgage and financing, and then yours truly, myself, Daniel, and Ari to talk about the real estate side of it. So let's get into it. Ari, if you want to take it away.
Fantastic. Well, good having you all. This is where we're going to be talking about your way to your first home. It is a really big step for a lot of people, so it takes a lot of mindset and saving to be able to come to that point. But congratulations if you are at that step that you're taking the leap to ownership. Now, one not only it's a big step, but also choosing a home and the financing program that's right for you is another challenge. Understanding the different types of homes. Hi, Evan. Yeah, so understanding the different type of homes and the loan programs that will fit your budget and also fit your lifestyle is important. And knowing what your goals would be, it's part of the decision making of how to finalize your first home in terms of the pricing and type of properties that you're going to be going for. Now, going to why buy instead of renting. A lot of people may ask that why they should go through the process of purchase versus renting the property. Well, the first is the ownership. The pride of ownership is one of the big things that everyone would love to have something of their own. And that is just not replaceable. You cannot have that feeling with the rent. And it's a good investment. When you're making money, you want to invest somewhere that when you're sleeping, your money will make you money as well. Generally, when you look at the real estate market, homes, they always increase in value over time. It's a long-term investment. So yes, it is not something to get in and get out right away. But when you're purchasing, that as you pay down the mortgage, you're not only forced to save that equity that you're paying down, but also the actual home value will appreciate. Another thing that it's important is the equity that you will build in, which we touched on, and the interest portion. Quite often, it's as part of your mortgage. Typically, they're tax deductible, so it helps you with your taxation as well. The main element when people they move from rental market to purchase is the stability. When you're renting, you're basically dependent on your landlord for as long as they are letting you stay in their home, so you can stay. But once they decide to either move back in or have it up for sale, then you're forced to move out. And living in Ontario, if you have newer properties, you don't have a rent control. Even on the ones that they have a rent control, you're subject to 2.5% increase anyways. And the other ones, they are open-ended. So you're saving money by having your own ownership and having more control on your life. And your money doesn't lose value with inflation. So that's a good thing of having the ownership.
Now, anytime you're looking to purchase at any point, you got to understand how the current real estate landscape is looking like. Once you understand the knowledge and where we're currently sitting at, then that is when you can properly recalibrate yourself to set yourself up for success. So we're going to go over the current market conditions, how things are looking at from a numbers perspective. Our firm, we pull the statistics on a weekly basis. As a consumer, you most likely are getting a majority of your news maybe from either TREB monthly reports or maybe it's from the media. The important thing to understand that those reports are behind by a month. Or if it's the media, sometimes they are behind by 3 to 4 months. At the end of the day, us pulling the weekly stats and being boots on the ground, we are seeing shifts in the marketplace far in advance than the TREB market reports put out once a month, or even the media does. They're usually a little couple months behind. Now, looking in first for the 416 active listings for the freehold. So that's detached, semi-detached, townhomes. This is for the last 6 years. So if you look on the left, the blue dotted line is where we're at for 2025. Currently in the 416, being Toronto, we're sitting at about 2,300 active listings. You can see right now that this is higher than any time that we've had in the last 6 years for this period of the year. the better part of about 18 months, we have been in a buyer's market, and the amount of listings available is a good indication of that. Similarly with condos, a little bit more of an extreme case. We're at about 5,800 active listings in the condo market, which is significantly more than anywhere we have been at this time of year for the last 6 years since 2018. Condo market for sure, we're far deeper into buyers territory than we've ever been in the better part of, I would say, maybe a decade and a half. So what does that mean for you as a buyer? That means you've got more options. You can take a little bit more time. You don't need to worry about, oh, it just hit the market, it's going to be gone tomorrow. And we can actually make sure that you're getting into something that you're going to enjoy and love for the time period that you're going to be in there. The next important metric that we use to see how market is behaving is months of inventory. Months of inventory, if you don't know what it means, basically what it is, it tells us that if no more listings were to come to the market ever again from today forward, how many months would it take for all the active listings to be absorbed, so to be bought by the market? The way to understand this is anything between 0 to 3 months is considered a seller's market. Anything between 3 to 6 months is a balanced market, and 6 months plus is a buyer's market. You can see for condos, we're sitting at about now 5.9 months. If you see on the right-hand side, and freehold about 3.7. Now, you may be asking yourself, Daniel, you just said we're in a buyer's market, but this is not matching the threshold that you just mentioned. Well, the textbook will tell you that 0 to 3 months is sellers and 6 months plus is buyers. But for Toronto, I like to give it a little bit of a Toronto discount. Reason being is Toronto has been in such a deep seller's market for as long as anybody can remember, that something like 3.7 months in freehold or 5.9 months in condo market for months of inventory is a significant change compared to where we are very used to being, which at one point we were looking at, weeks of inventory, not even a month, right? So something like this, even though the textbooks would tell us that we're in a balanced market for both, we are definitely in buyer's market for both of them. Now, one piece here that's important to pull is we can see ever since beginning of this year, around January time, we are seeing the months of inventory starting to trend downwards. So you can see January 21st is when it peaked at about 7.9 months for condos, 5.5 months for freehold. And now it is starting to trend downwards as we head into the spring market. What does that mean for you as a buyer? That means we are slowly starting to see things swing into a balanced, and for freehold, a little bit potentially of now seller's market territory. And that's for a couple reasons. Obviously, number one is interest rates. Interest rates were a big challenge for anyone that was looking to purchase, as we're not able to get qualifications. So as that comes down, obviously we're going to see more qualified buyers. But more importantly is the new mortgage rules, which maybe Rami will get into once he's in here. But the new mortgage rules came into play December 15th of 2024. If you're not aware of it, it's got to do with CMHC mortgages. So those are folks that are buying for themselves and buying with less than 20% down. And I'm sure William can talk a little bit about it, but just a high level, the gist of it is if you're buying with less than 20% down, previously you could only do so to a max price of $1 million. Now they've increased that to $1.5 million home. Additionally, if you're an end user, you would be able to get 30-year amortization versus a 25. What does that do for you as a buyer? Brings your payments down by a few $100 per month. So these things is a bit bigger influence to what we're seeing than the interest rates, which is why we're starting to see activity kind of start to pick up a little bit. Nonetheless, definitely still in buyer's market. Looking at the overall market stats in terms of the numbers for January 2025, that's the most recent numbers you've gotten. GTA benchmark price, home price for January 2025 was about $1,070,000, which is up 0.2% year over year. Average home sold price in the GTA increased by 1.4% year over year. Detached home increased by about 2% year over year. Same with semi-detached and freehold at 0.9 and 2.1 respectively. And the condo market did actually decrease by about 1.7% year over year. Now, why is this important to consider? This is probably, I think, the first month we have seen an increase in price year over year for the better part of the last maybe 18 months. It's very evident here from what we're seeing in the months of inventory that the interest rates and the new mortgage rules are having an impact in the market. Naturally, freehold market is what is you're going to see turn around first. Logically speaking, there's only a finite number of freehold properties in the city. Builders are not building them as much as they used to. And being a more desirable property type, once people get to a position that they're able to afford with the rates, with their cash, whatever it might be, they're going to flock there first. And then we will see the pendulum swing towards the lower asset types like a condo, maybe later in the year, depending on how things go.
Now, factors that impact our market. There are several factors, one of them being the interest rate. So typically when the interest rate comes down, there are more interest on people, the affordability will go up. And once the affordability goes up, so that's when we will see renters, first-time home buyers, they're jumping back into the market. And it will make it easier even for downsizers or upsizers in terms of the carrying costs. Second would be the housing supply. When we have shortage of inventory, that's when there will be more demand, and it will push the pricing higher. But when there are a lot of supplies, then that by itself would make the competition for the sellers more fearful, so the prices would trend downwards. One of the other factors in the market that will impact our market is employment. So long as the employments are, at high, and companies, they will open up their headquarters or offices in a location wherever that might be. It attracts people to join that force of work. Hence, they will need accommodation for that, and the interest of that location will go higher, or overall of the market. So the stronger we are in an employment sector, the stronger of market we will have. And last but not least would be the population growth. If you continue on having as many people, immigrants coming into the city, and especially for the past 18 months that there hasn't been much of construction happening, eventually this will cause the shortage of inventory, and there will not be enough homes for everyone that they are here, and that will push the market to be at a higher level.
Now, just to touch a little bit on housing supply. Look, no one can tell what is going to be happening in the future. It's impossible to see through space and time. What we do know is the absolute facts, which is due to the rates that we've had, the same way that the high interest rate environment has impacted at the consumer level, it has had major impact on the builders in this city tenfold. A lot of projects and inventory that was supposed to come to the market to help get the market to a more affordable state, as what the people in government is aiming for. We are seeing that the construction starts and completions will be dwindling out by 2028. So in about 5 years' time, we are going to start to see a massive supply crunch, more than we've ever seen, because a lot of new construction that was slated to be finished in the next 3, 4, 5 years, projects have either been shelved, canceled, or delayed indefinitely, because the same way interest rates are impacting consumers, they are absolutely crippling the builders to discourage them from building at this time. So it is something to consider. It's an interesting thought to say, okay, where are we going to be possibly in 5 to 7 years? And at the rate that we are building right now, then we are potentially in for tighter supply in the next 5 to 10 years.
Now, considering each of the properties, like what are the consideration for each type of properties? So, things to consider when you're looking at single-family homes or condos or townhomes are carrying costs and the type of asset class they are. One of them is the maintenance. In single family home, you do not have the maintenance fee. You may have a puddle fee, but there is no maintenance fee. And the puddle fee is when you pay small amount of money for the roads that have not been assumed by the city. So that's what you will pay to maintain the road, and basically the garbage removal and all that. However, when it comes to condos, whether it's a condo apartment or condo townhouse, you will have a maintenance fee. Some will cover more of your utilities and some less. And that's something as part of the cost to consider. However, if it's a single family, you still have the regular maintenance, those things you need to do it yourself, fixing the roof, windows, driveways, shoveling snow, and cutting the grass. So those are still extra costs. Now, the responsibilities. With condos, you can just lock up the door and leave, which makes it a more favorable lifestyle for a lot of people. However, with the single family home or sometimes even townhomes, there are some responsibility that you will have in maintaining the actual structure of the property or the surrounding of the property. However, for some families that they would like to have the backyard, front yard, or white picket fence, homes are more favorable. Then it comes to the amenities. You do not have any amenities when you are as part of the townhome or a single family home, but with condos, you do have arrays of amenities from pool to meeting room, party room, and all the rest of it. And they are getting bigger and bigger every year on newer condos. Now, the investment potential. If you have to put them in an asset class, like from the best type of real estate to the least favorable type of real estate, depending on the budget, the entry level would be your condos typically. And then you will go to townhomes, semi-detached, and single-family homes. So because you will have more skin in the game, with single-family homes being a higher ticket price items, so you will have more down payment, and probably you will have more of the win on their end. But it all boils down to the pricing that you will purchase. Now, coming to different markets, Daniel, you can take that part on.
So now you're calibrated with the market. You understand where we're at, where we're headed, and you've even maybe decided what type of property you're looking for. The next step is which type of market will you be looking in? We've got three different types of markets here. We've got obviously your resale, which is your traditional real estate. That's the stuff you see on MLS, realtor.ca, all these public websites. Then we've got pre-construction, and then we have assignments, which are all off-market properties. So you won't find them anywhere online. What is the differences and what are the pros and the cons? Basically, what it really comes down to is 4 items: price, down payment, time, and age. So with the resale market, there is a wider range of pricing because we have properties that are 1-year-old and we have properties that are 100 years old. We have properties that are in really good shape, and we have properties that maybe need a little lipstick to look a little bit better with some TLC. So you have a wider range of pricing in the resale market. With pre-construction, it's usually the most expensive type. That's because builders, the way they do their pricing, it is based on, is more significant to their expenses that they have, government taxes associated with it. And then with assignments, it's something in between. Traditionally, assignments, which are off market, the pricing falls anywhere between resale and pre-construction if we're looking at apple to apple product. However, what I will say, in the last 18 months, we have started to see the assignments market actually dip below the comparable resale, which assignments typically were always an investor favored type of market. But the last year or so, we've had a lot of folks that were end users, particularly first-time home buyers, call us for assignment sales because they're seeing the kind of values that you're able to get in that market today. The next aspect being the down payment. So with your resale purchase, you need your 20%, or if you're going with an insured mortgage, then it's your minimum down payment of 5 or 10%. With pre-construction, you need to follow the deposit structure that the builder is offering, which again, it can also vary from 5 to 20%. Majority of the projects, however, are 15 to 20% down payment that you will need. And then with the assignments, it is also similar that it'll be anywhere between a 10 to 15% down payment that you would need for that. Thirdly is the time. So what do I mean by time? With a resale purchase, it's anywhere between 30 to 90 days closing. So from the time that you have an accepted offer, you can move in anywhere between 30 to 90 days is typically what we see. With pre-construction, depending if it's a low-rise or a condominium, you're looking at anywhere between 1 to 5 years plus from the time that you purchase to the time that you are moving in. And then with assignments, it's somewhere in between. Usually it's anywhere between 4 to 12 months, sometimes maybe a little bit sooner, sometimes a little bit longer, but 4 to 12 months on average is what you're looking at if you purchase an assignment to the time that you're moving in. And then lastly is the age. With resale, things, again, like I said, it can be brand new, it can be 100 years old. With pre-construction, obviously it's going to be brand new. It's going to have all the bells and whistles, the latest trends that are coming along. Like to give an example, when COVID happened, all the condo builders in pre-construction immediately implemented high-tech air filtration. Another example is, there was a time where 8.5-foot ceilings were very common. But the pre-construction at the time saw the trend going towards 9.5, 10-foot ceilings. So the newer product will have some of the more higher tech features and finishes. Similarly, with assignments is very related to pre-construction in that sense. Assignments are also a brand new build. So once you determine these 4 aspects, okay, what is more important to you? Is it the pricing? Is it, being able to stretch out your down payment? Is it the time horizon from the time you purchase to moving in? And do you care more about the age or not? Then we can kind of help you, guide you into which market you should be focusing on. I won't get into the pros and cons here. If you are interested, we got a really handy ebook that goes over everything with some case studies on if you bought a resale versus pre-construction or assignment. If you're interested, then feel free to reach out. I'm happy to send this over to you guys so you can have a more detailed breakdown of the 3 different kind of markets that we have. All right.
Okay, so now it comes to assessing your financial situation. Budgeting is one of the most important thing that you need to do when it comes to the home ownership. What I always recommend to my clients is just put a bit per month and commit to that on regular basis. And you will be surprised how much you will actually save by the end of that year. Even if you allocate 10%, 5%, or whatever the amount that might be, you will come up with the down payment very quickly because it's intentional. Then it's understanding your mortgage options and pre-approval process. It's important for you. A lot of people, unfortunately, they get to the excitement of the purchase, looking at homes and putting an offer. And that's when they are committed emotionally to the property, that's when they will start, exercising, different type of mortgages or how much they actually qualify for. But the right way of doing it is reverse. Get your down payment in place. Have your conversation with the mortgage advisor and just understand what are the different type of mortgage options you have out there and get your pre-approval in place. It's important for you to understand what is the maximum last dollar of the for your purchase should be, because it's so easy to get into the process and you will go 10, 15, 20% over than what you actually intended to go. But when you have a hard stop, then you will know what your maximum dollar would be when it comes to purchase a property. It will save you, it will save your realtor, and it will make it a happy ending for all of you. And then saving for down payment and closing costs. It's part as a closing cost for every property, depending on where you're purchasing, and your carrying cost. So carrying cost is through your mortgages, property tax, utilities, and all those things that you need to think about. Closing cost is your land transfer tax and your legals. So, and if it is a resale, if it is a pre-construction, or if it is an assignment, there are differences of closing costs. And as Daniel mentioned, we have a good ebook that we can send out to you so you can review it, so you can get yourself familiarized. Those are the money that you cannot be part of your mortgage, so you need to have that fund cash in advance for your closing. And in truly evaluating your affordability, it's important to know how much you can afford when you stretch yourself, but not stretch to a point to break your back. Because if you're going more than what you can actually afford, then there will be time that the element of surprise will kick in, and then it will mess up everything for you. So if you keep these key points, it will help you to have a good start, and there will be no element of surprise till the end. Now it comes to your financial assistance program. As a first-time home buyer, there are, programs that are available to you. One of them happened to be the land transfer tax rebate. So if you're buying in City of Toronto, or you're buying in outside of Toronto, there is a calculation that will go into play to tell you how much of land transfer tax saving you could have. So basically, the way you will do that is just, if it's an Ontario land transfer tax, minus 1.5% of purchase price. Toronto land transfer tax would be almost like 3% of purchase price. So as a first-time home buyer, you will be able to get a total of $4,000 of outside of Toronto and about $8,500 inside of Toronto as a rebate. Then you will go back to the HBP, your home buyer's plan. That's a program that allows you to withdraw up to $35,000 of your registered retirement saving plan, which is your RSP, and buy, and whether it's a pre-construction or it's a resale, doesn't matter. You will be able to use your RSP towards it. And you have X amount of years, 15 years period, to repay it back to RSP. So if you do not have an RSP, when you do have your conversation with your mortgage broker, I'm sure they will guide you to have that in place. And as long as, I believe, if there's 3 months, the funds is in your account, you're able to pull them out and put it towards your down payment. So it helps. It may not be as much, but it helps. Every bit helps to have a better down payment and lower carrying costs for yourself. Now, going back to who qualifies for first-time home buyer and buyer land transfer tax. So you need to be an 18-year-old. You need to be a Canadian citizen or permanent resident, and you should not have owned a home anywhere else in the world. So there are certain criteria, and if you're a spouse, must not have owned it. So if you're buying with somebody, a lot of times people make a mistake. One party is a first-time home buyer, but they're buying it in partnership with someone else, whether it's a spouse or it's a partner. And the second person is not a first-time home buyer. So when both names go on the agreement, you're basically forfeiting your benefit on the land transfer tax that you had. So it's important not, understand how you can get that qualification before you proceed with your offer.
Forfeiting only half of it.
Half of it, yes.
Half of it.
Yeah,
so instead of $4,000, if let's say you and your partner, one of them's a first-time home buyer, the other one isn't, for the land transfer tax rebate, instead of the full $4,000, for example, 50% of it you'd be able to claim.
Exactly. So this is it. So property criteria must be, it must be primary residence. So if you're buying as an investment property for your first home, it doesn't actually qualify to get the tax rebate. And a rebate applies to both type of properties, whether it's a new or a resale home, it applies to both.
Perfect. So that's on that. By the way, guys, we do have a little Q&A section on there. So feel free, if you have any questions, punch it in there, and then we'll be having a segment at the end to kind of go through it together and answer it. Now I would like to introduce Mr. Rami Ibrahim from TD. And he's going to talk a little bit on the mortgage side. Oh, I think you're muted still, Remy. There you go.
Is that better?
Hell, yes, it is.
Okay, awesome. Thanks, everybody. Had some technical difficulties, but we're in. So,
Amazing.
Daniel and Ari, I mean, I couldn't say it better. I mean, I learn every day, and what you just went over, I want to keep a copy of the deck of all the rebates and reminders that you send out, because I forget these at times as well, right? So. Myself, I work for TD Bank. I've been with the bank for several years now, strictly in the mortgage space. So my title is actually a mobile mortgage specialist. I've been with the bank since 1995 in this role exclusively for about 20 years. And I can honestly tell you, if I haven't seen any all types of financing, I've seen it all basically. So obviously, in terms of policy changes and so forth and whatnot. But my role today, and I guess just to sort of cover off, there's some slides that we can share with you, and obviously there's a Q&A session at the end. Keep it brief, but we're already left off with the importance of the pre-approval and so forth, and just basically looking at what is your budget? How do you figure that out? I mean, how does the bank sort of assess these things? Because if you're going to be looking at homes, number one thing is, how do we assess these things? So we're going to walk you through, what that looks like, how that pre-approval is generated, and then once that pre-approval is committed, you can definitely, continue with your home search, whether it's new construction or resale. When it feels right for you, basically. But essentially, when we go through a pre-approval process, and you might have done this online with some of the audience, that are online right now, or if you've done it before in person. In terms of it, bank obviously looks at your income. That is the one driving factor of anything that we lend on, whether it's a personal credit card, whether it's a mortgage. So the bank's always going to want to look at your income. Now, how do we look at your income, and how do we assess that? Basically, we look at your gross income. So, for example, if the gross household income, let's just call it, $100,000, bank will take a percentage of that amount. It's usually about 44% of that amount. So if you take 44% of, let's just say, $100,000, that's about $44,000 a year. And basically, that's what we call your total debt service ratio when we try to pre-qualify you, essentially. And when you look at doing the pre-approval, what we're going to look at is your gross income. And I think we need to understand you better as an individual. What does gross income mean? Are there bonuses? Are there overtime? Are there shift premiums? And I think we need to really have a good dialogue to understand that we've captured everything. Is it a family? Is there a child tax benefit that's income and so forth? These are all things that add to the income, which is all part of your budget. And these days, when we're pre-qualifying individuals, policies are pretty much regulated on what's called a stress testing rule. We've had this for a few years at the bank. So basically, what happens is there's a government rule set out that says every time you qualify an individual for a mortgage, there's a stress test limitation. And usually the actual definition of that stress test is whatever your mortgage rate is, we add 2% to it, and that's how we qualify you. So to give you an example, if today's current interest rate, let's just call it, for argument's sake, if it's 4%, we add 2% on top, we qualify you during the pre-approval process at a rate of 6%. You don't pay 6%. It's a safeguard. And what happens is that is how we sort of, test your ability of that total debt service ratio that I touched on earlier when I gave you the example of, that $44,000 a year scenario. That should basically be all of your debts combined with that stress test rule, basically. So if we have, let's just call it, for argument's sake, let's not use 44,000. Let's just call it that we had a maximum of $36,000 a year, just for simple math. That works out to $3,000 a month. So basically, $3,000 a month encompasses your mortgage payment, your property tax amount, condo fees, and usually condo fees, we use 50% of that value. We don't use the full 100%. And essentially that dollar amount will give us that maximum amount that you can borrow at that stress test rule to see where you stand basically. During that pre-approval process, we are going to ask for, documents from you to validate your income naturally. And what's going to happen is when we validate your income, we're going to go through your credit history. Yeah, we're going to go through, Ari touched on this, earlier with your down payment and so forth. So all of these things are looked at basically, and essentially that builds the rationale or the case for why a lender is going to pre-approve you. And there's many lenders that have, different policies and so forth, but for the most part, they're pretty much the same. Everybody's governed by the stress test rules, and pretty much that's what we have to abide by, because the regulator views all the lenders and they audit the lenders' files, and we have to have prudent lending practices basically, which keeps the market healthy. And obviously, you don't want to overextend yourself, either, to get into that scenario. What I will touch on though, a pre-approval is, never guaranteed forever. There are limitations in it. And what that means is if you're coming to me, after this session for a pre-approval, and we gladly look at evaluating you, we're looking at you point in time. So point in time, this is your income, this is your credit, this is your down payment, your credit history, is what it is. If there's any changes in those aspects, then that's going to void your pre-approval. So basically, I get a lot of this lately where, especially, these days where, a lot of people might be working salaried, they want to start a new business, or, they take on a contract job because there's tax benefits involved. So what I always tell them is, when we're doing your pre-approval, this is based on today. You're a salaried individual. We have to make sure that you're still, with the same, company, the same, income, because that's what we pre-approved you on. So we're committing to you to tell you, you're qualified for X amount, but we just want to make sure that everything is remaining status quo. So it's very important that you keep your credit history in good standing during that pre-approval process. You don't take on new credit during that pre-approval process either, because what's going to happen is you take on credit during that pre-approval process. That could be an extra liability, which sort of goes against you in that earlier figure that I gave you of the percentage of your income, because we look at your outflow of all of your, expenditures and so forth. If your job changes, again, you could be on probation. You could be, you might have a contract role where you've now technically become self-employed, and usually, self-employed person, there's different parameters and so forth. So for the basis of this, tonight, we're going to just keep it simple and just leave it, under a general salaried, audience. And again, if there's questions and so forth, we can go through, those one-on-one or answer them at the end of the session. But for the most part, that's how the pre-approval is issued. The other aspect of the pre-approval is an interest rate hold as well. So the benefit of that is when rates are lower, they could go up any time. So when we pre-approve you, the rate that the bank will extend to you, and I can only comment for TD Bank, I can't comment for other lenders, but typically, we give a 120-day rate guarantee. Some lenders offer 90 days, some offer, a shorter period of time, but that's a benefit to you because there could be some cost savings in a rising rate environment. And we've seen that. There's been some volatility in the rates. As of now, rates are on a downward trend, which is a good thing. And what happens is if we're on a downward trend, we can always refresh that pre-approval and, give you the lower rate. But if rates start climbing, obviously that takes impact into your mortgage payment. And again, you want to set your proper budget as a safeguard. So, if a rate goes up 0.25% or 0.5%, and you don't have a pre-approval and you don't have a rate hold, that's more money out of your pocket as well. It might be minimal, or you might not think it's a large amount, but again, it is every dollar helps. And as Ari mentioned earlier, when we're doing the pre-approval, we're going to try to stretch out your budget for every single dollar. some of these rebates, some of these tax credits. But again, you know, in terms of your cash flow, that's important as well to look at these other expenses to, you know, keep that mortgage payment down. But I mean, in terms of the general rule of thumb, you know, pre-approvals are good for 120 days. You know, the rate hold is good for 120 days. And when you have that in your possession, then it gives you some confidence that when you're going out on the market, this is, you know, that you're safe to sort of, you know, buy that property. I will tell you though, and again, it's very, you know, it's very important to understand, our pre-approval is never a final approval. So what you need to understand is we're essentially telling you this is the barometer of what you can, you know, qualify for. We haven't seen the property. You know, we have to appraise the value of the property. You know, does it meet our lending standards? Does the property need work? Is it a fixer-upper? So think of it this way: as a lender, during the pre-approval process, we don't know what you're buying. So I might issue, you know, a commitment to you, and then you might go out and you buy a commercial property, or you're buying a property that has, you know, let's just call it, you know, an as-is property that needs renovations and so forth. So we might not lend on that property because as a lender, we need to sort of understand, you know, what that property is, what the value of the property is. So when we do the pre-approval, it's you as a personal individual. It has nothing to do with the property or the value. And what I find is, you know, as a first-time buyer, especially if you're going to be putting down, you know, a lesser dollar amount, whether it's, you know, 5% down, 10% down, and so forth, what happens is, I would always urge you, and I think, you know, when we chat about, you know, the high ratio insurance, which William is going to be covering off shortly, we just need to touch on that. Basically, it's always prudent to put a condition on financing in an offer, especially when you know, if the property might have some concerns, if the property needs high ratio insurance, because that final approval, again, we need to be okay with as a bank. And if there's high ratio financing, you know, they need to be, you know, on side with the value as well. And I'll give you an example. If you're going to be buying a property, say for, you know, $500,000, and you will have a 5% down payment, that is a, you know, $25,000 down payment. Now, when we're pre-approving you, and then you so happen to fall on the property of your dreams, and it meets the criteria, and it's a $500,000, you know, price point. If you go in with a firm offer, and what I mean by a firm offer, that is an unconditional offer, basically, where you're putting in no conditions, that, you know what, I received my bank pre-approval, I'm genuinely approved for this property, so I'm not putting in any conditions in my contract with Ari, with Daniel, with Jonathan. So what's going to happen is, you go in firm, I cannot guarantee you, you know, if I'm going to lend on that property, if I'm going to, you know, have the value maintained as well, because lenders are going to basically try to understand what the value of the property is, and appraise the property as well. So if you overbid and you only have a 5% down payment and you don't have anything else to fall back on, you just have to be careful and understand that, you know, we're the experts here to sort of guide you through this. We'll look at you individually to sort of understand, you know, where you're at. You know, do you know the risks of going in with a firm, you know, approval? Do you know the risks of, you know, going in with a conditional approval? And just to sort of understand these things, because we want to, you know, protect you. We never want to, you know, sort of guide you or misguide you in a way that's going to harm you during this process. Because if you've never done it before, we've seen it all. You know, Evan can tell you that he's seen deals fall apart. You know, Ari, Jonathan, Daniel, you know, myself, you know, William, we can tell you that we've seen deals not get approved either when people perceive that they had a pre-approval. So just word of caution on, you know, what it means. And I would always tell you, I mean, this day and age, like I'm a 70s kid. A lot of individuals, you know, go online for pre-approvals and so forth, which is great. It gives you a barometer, but you really need to have that face-to-face, you know, contact. You need to have that personal relationship to sort of walk you through it, understand it. Because if you're putting in the wrong data, if you're putting in, you know, $100,000 because that's what your company is making every year, but on your income tax on the personal side, it's not $100,000. It's very important that, you know, we need to drill down a little bit deeper to understand you, understand your family. You know, what are we using as a lender to give you that confidence? What do we need to change? if if your credit history is not established, if you've got poor credit history, how do we save for a down payment? Can we put you on a budgeting path? Can we get you into a home buyer savings account? Things like that. Do we contribute to an RSP, which helps you during the pre-approval process to maybe get a larger tax credit and so forth. And again, just with the window of time that we have today, we want to respect everybody's time. So if there's any questions and answers, we're here to help post webinar, or we'll have a chat after the queue. If you have specific questions about your own household and so forth, that's where the one-on-one comes in for us to sort of guide you and try to get you there basically. And in terms of financing checklists and so forth, one of the slides that you'll see, and it's called a home financing checklist that you'll actually see. It just sort of gives you some documentation that we need, and again, we can share this with you, so to have you ready of what to bring in when we're speaking to you, whether it's assets, whether it's your tax assessments, whether it's just more of a checklist to sort of follow. But I mean, again, before you're buying, it's important that we're spending the time with you to sort of understand. If you can't do it on your own, do we partner you up with anybody else in your household? Do we put a larger down payment, down? These are all things that we'll discuss and so forth. In terms of the actual agreement and making the offer, again, we touched on that earlier. And again, you can go in with a firm offer, but I would always urge you that before you're making a firm offer, sometimes that helps you get a better price. Sometimes in today's market, or if I'm an owner and if I have an offer with a condition and an offer that doesn't have a condition, I'll probably take the offer that's that doesn't have any conditions. But having said that, let the lender and let myself tell you whether it's safe to do this, and if you do it, what are your downfall, what are the risks involved, what could happen, what's your backup, and just to sort of understand these things before you actually present an offer, if that makes sense. In terms of products and rates and so forth, which again we're going to touch on, standard traditional mortgage that we offer individuals. We offer home equity line of credits to individuals as well. In terms of interest rates and so forth, and amortizations, for the most part, a nice sweetener that came in recently is, we've high ratio financing. It's been extended, to be looked at for up to 30 years in certain cases where it used to be 25 years. And sometimes that helps from a cash flow perspective. Essentially, when you're starting a family, if your income is increasing, basically. So that's a great benefit. We've increased, or as a whole, the government's increased the purchase price as well, and all these things are to sort of stimulate and benefit that individual, to sort of give them more choice, because especially being in the GTA, when the policy cap was at about $1 million, a lot of families struggled because a lot of these prices were a little bit more. But again, there's a lot more options available that we've got. There's different programs that we have as well, especially for a first-time buyer, that things that you can renovate the property. There's something called a Purchase Plus Improvements program, where you might be going door to door after the pre-approval is done, and I made like a list of all the properties of interest, and it might need work. And you've already spent your money, or you've already worked hard to save all your money for the down payment, and you might walk away because it doesn't have a finished basement. The kitchen has that 70s look, the basement has that 70s look. You want to fix it up, and so forth. So we'll help you give you money to help improve the property, and typically we're okay to give you about $40,000. And what happens is, again, when we're pre-approving you, I'll ask you those questions, and I'll, when I understand your income, and I'll actually tell you, hey, listen, you've got this, this is what you're working with, this is what your savings is, we budgeted, your land transfer taxes, your closing costs, and so forth. And now, you might need some extra money to do some rentals that you don't have. You don't want to put it on a Visa card. You don't want to, get a loan for it, 'cause that's an extra payment. So what happens is, if your purchase price, let's say, is, call it, $400,000, and you want to put 5% down, that's a 20% down payment. But now, if you wanted to do some work to the condo or the home, let's just call it, we can typically give you $40,000 during this pre-approval process, and now, we'll hopefully value the property at a higher amount. So now your 5% down is actually based on the $440,000, rather than you spending the money on your own. What happens is we add it to the purchase price. So originally, we would ask you for 5% down, and again, just for simple math, a $20,000 down payment. Now, if we make your purchase price $40,000 more, because you want to use that money to improve the property, the improved value of that house is now $440,000. So now we're going to ask you for 5% down on $440,000, which is a benefit to you, because again, you can add that to your mortgage payment. You can amortize it over a longer period of time. Because imagine you taking $40,000 from your credit card or a loan. Usually these things, or a loan is usually amortized over 5 years. So that'll probably work out to about $800 a month. And on a credit card, usually the creditor wants, 2-3% every month. So on $40,000, even at a 2% minimum payment, that's an $800 payment a month as well. So that extra $40,000 within a mortgage, it might cost you, an additional, $150, $200 a month to borrow that, and you can amortize it. It's one payment, and again, you've got the money to do the work that you need to do, basically. But I mean, that's all I want to touch on, myself personally. In terms of the slides, I guess, the home financing checklist, I'm not going to go through all the documentation that we need. The importance of the pre-approval, I think we've actually covered, and why it's important. I'm not going to get into the rate environment, or what's best to do, what's not best to do. That's based on your own individual circumstance. Rates have come down, just to sort of give you a quick synopsis of where the rates are. Variable rates have come down. There's still a lot of uncertainty with some economic issues that we have with tariffs and so forth. But I'll give you an idea. Fixed rates last year, 3, 4, 5-year rates, they peaked somewhere near 5, 5.5, 5.75%. Fast forward, they're now in the 4% range, depending on what you're looking at borrowing, and on your specific term as well. So the good thing is they've come down. No, they're not historical lows from what we had during COVID. I mean, the lowest rate that I've ever done personally was a rate of about 1.5%, which I gave probably in 2020. So we're not at those levels. We're not going back to those levels. The only time you see these levels are in emergency circumstances, where the government implements these measures to sort of stimulate the economy and so forth. But at this point in time, I don't think those days are coming back. But historically, like to let I mean, anything that you get historically, if your rate is in the 4 or 5% range, historically, that's a great rate, because it's never as high as a credit card, never high as a loan. In terms of it, the mortgage market in Canada, to have that type of rate, to sort of look at you as an individual, I think it's a great barometer to use, and I think it's a fair rate to use as well. And when we're looking at your affordability, I think you always want to look at looking at what your income is at the higher rate, and that's what the importance is of that stress test that I talked about earlier. Because when we add 2% to income test you, we're looking at your rate at a potentially higher rate to safeguard you. Yes, you won't pay that rate, because like I said, we're in the 4% range now. However, that renewal cycle might come up, and that's why we're sort of safeguarding you to ensure that there's no harm to you as an individual, that you can sort of go get through that higher rate cycle if it is at the high point, and hopefully during the low point, your family and your household does well and pays down their principal a lot faster. But that's all I wanted to add, and I'm sure we'll have some questions at the end. But thank you, everybody.
Thank you, Rami. Thank you. Okay, and moving on, we've got Mr. William to talk about CMHC.
Thank you so much. I really appreciate the invitation tonight. Good evening, everyone. My name is William. I'm one of the account representatives with CMHC, the Canada Mortgage and Housing Corporation. And tonight, I really just wanted to give a brief overview in terms of what mortgage loan insurance is and what that really means to you as a potential buyer. Now, just a bit about CMHC and what we do here at the end of the day. You may have heard of us from media, social media, and really the overarching thing that we do here, and what we're known for is mortgage loan insurance, of course. But we do a lot of other things. We do offer housing finance solutions. We deliver housing programs on the commercial side. And of course, we do post a lot of housing market expertise in the form of housing market outlooks, and of course, our mortgage consumer survey. But of course, most of the time I do present to mortgage professionals and even real estate agents. But tonight, I know my audience is potential home buyers. So of course, our conversation is going to be more so relative to, what does this mean for me and how do I navigate the housing market? I think that's really important to really have that conversation. So quick question here. I mean, well, not really a question, but more so a rhetorical question here. But what are the pathways to home ownership? And when we really think, what the pathways are, really it can be simplified to, just having cash, selling property, inheritance. We take that cash and just buy the property outright. But of course, if you're potential first-time home buyer, and you're out on your own, you're going to save for a down payment. And of course, saving for a down payment, this could lead to a couple things. I mean, first of all, it's more so, how much down payment do I have to save? Does it have to be 20%? I mean, when I look at these MLS pricing listings, 20% for $1 million home is a lot of money. Can I start lower? That really leads to this one, or this next slide over here, which is, you can actually get into a home with less than 20% down payment. Now, of course, starts at 5%. And it goes all the way up to 20%. And now, of course, this can really be summarized and categorized into two buckets over here. You have 20% and above, you can get into a home with really no questions asked. This one's more so very simple. And really, most of the time, people are misinformed in terms of, they have to have 20% down payment. There's nothing less. On the flip side as well, when we talk about high ratio mortgages and getting them for less than 20% down payment, it could be a little bit intimidating, because when you think of mortgage loan insurance, a lot of things that may come up. Oh, the insurance piece, I don't want to offer insurance. When I hear insurance, immediately I hear cost. But if you do decide to get in with less than 20% down payment, you are able to, but you have to play within tighter rules. Now, what does that mean? Well, that means that when you do get in with less than 20% down payment, so let's just say 5%, there is a mandatory premium that you have to pay. Now, let's talk about mortgage loan insurance for a second here. Let's hold that thought. What is mortgage loan insurance? It's not some sort of protective for yourself in case you can't make the payment and whatnot that you would normally get at a bank. But mortgage loan insurance is a mandatory. It's mandatory for any borrowers looking to get in for less than 20% down payment. So if you have this conversation, let's just say you decide to get the mortgage, you want to go with 5% down payment, it's mandatory for yourself to get mortgage loan insurance. There's no negotiation on it. This is a government regulated business. Now, of course, broadly speaking, mortgage loan insurance protects the lender. So if I use an example here, TD is going to be my client. CMHC is one of the insurers. Now, we insure TD's mortgage, which is the one you would be taking out, in case of payment default by the borrower. For some reason, they can't pay it. Of course, we do work with the borrowers to make sure that some sort of payment plan is or some sort of solution is arrived at so that you can make your payments. But in case that happens, we do insure that mortgage. And of course, we back that mortgage for TD. Now, when I say mandatory, there is that cost. Now, I guess this would lead to the next question, or sorry, more so just clarifying just a couple of things here. I'm jumping the gun here. Anytime we hear mortgage loan insurance, high ratio mortgages, 5% down payment, I'm just gonna kind of lump them all into the same thing. They all mean the same thing, or more so, it's the same topic. So just so if you don't get confused out there, because I do cut out a lot of bank jargon. I do know that it's often very easy to get confused there, but this would lead to a next thought here. Why would I even want to entertain an insured mortgage, or insured mortgage versus conventional? Why would I even want to get in with less than 20% down payment if I'm paying a premium? It costs me nothing to save for 20%. I can just save for 20% and just get into the home. I don't have to pay for this insurance thing. I don't have to talk to William about this. Well, really, I think it's really more so in mindset here, and really what the conversation is for yourself. What's the goal here at the end of the day? On one hand, yes, you can save for 20% down payment on $1 million mortgage, or maybe even more so, you have the help from mom and dad. But oftentimes, people don't have the help from mom and dad, and maybe for yourself, only the best you can come up with at the moment is 5 or 10% down payment, and you see a great deal out in the market that you want to get in right now, or maybe you want to stop paying rent immediately and you want to put that towards your mortgage, and 10% is all you have, or maybe even 15% down payment. Now we want to think about the gaps here. 10% down payment to 20% down payment, 100,000 versus 200,000, or sorry, 100,000 versus $200,000 down payment over here. Big gap. And of course, if 100,000 is all you have at the moment, mortgage loan insurance may be something you want to take a look at. But the real point here is you can get into a home faster, and more so an express pathway to home ownership. Oftentimes when I do deliver these presentations on the basics of mortgage loan insurance, I do have people come up to me afterwards and just talk about their experience on their first time getting into a home. They got a high ratio mortgage. They started off, with 5% down payment. Over the years, they built equity in the home. They sold that home, and of course, their second home, they never needed mortgage loan insurance anymore. But this is more so a first step for everybody. And the real reality is mortgage loan insurance may not be for everybody. That's just the reality. But what you really want to have that conversation with your mortgage specialist, that, which one is the right for me? Is saving for 20% the best move, or going with 10%? Or maybe you already have 20%, but you don't want to commit all 20% into your home. Maybe you want to just do 10% and keep the other on hand. You don't want to be house poor. You want to at least have some sort of cash on hand. That's also an option too. And we'll talk about the costs after, and just briefly what that means to everybody here. So of course, just the basics of mortgage loan insurance, the guideline over here, and really just I want to more so highlight the maximum property purchase price. It's been moved to 1.5 million, as the others have alluded to earlier, but this is massive, especially in the GTA. When we talk about mortgage loan insurance in the GTA, or more so Toronto, it was like oil and water. Before, it was at $1 million. So even if you had 5% down payment and you look for a property that's $1 million, maybe just slightly over $1 million, you cannot get mortgage loan insurance. You had to look for a cheaper property, or you had to save for 20%. Now, this property purchase price is also something that is non-negotiable. It cannot cross $1.5 million now. But of course, it's a lot of breathing room as opposed to what we had before. So of course, you as a borrower, who are the people eligible? Canadian citizens, permanent residents, non-permanent residents as well. So if you're on a work permit, or if your spouse is on a work permit, you are able to qualify as well. Down payment is pretty straightforward. It's normally how we would, do it for conventional mortgages as well. You have your savings, RSP withdrawals, and of course, a gift does count as well. But the down payment is a little bit particular. When we talk about the down payment here, let's just say, for an example, you do decide to purchase that $1 million home. If I only put 5%, is it just 5% of $1 million? There is a way of calculating it. And of course, when you do work with your mortgage specialist, they will work with you on, what that down payment calculation is. I'll keep it very simple here. The first $500,000 of the purchase price is going to be for 5%, and the remainder is going to be for 10%, all the way up to $1.5 million. So whatever you have in that $1 million example, first $500,000 is 5%. The other $500,000 is for 10%. Now, my example here on the screen, $600,000 purchase price. It illustrates a down payment of $35,000. So it's roughly around 5.8% is what you would be putting down on a $600,000 property. So we would calculate your debts as it normally would, but of course I don't want to get too much, get too stuck in the discussion of this. But your minimum credit score is 600, is what you would to qualify as well. Amortization basically just means, how long can I stretch my mortgage for? When you do get a 20% down conventional mortgage, you can go to 30 years, no questions asked. However, for insured mortgages, like I said, you play within special rules, more tighter rules here. It's 25 years for everybody here. Unless you're a first-time home buyer. If you're a first-time home buyer, you can go to 30 years. It's around $200, around average $200. It frees up more for yourself per month. In calculation-wise, that's huge, just because it helps with your overall qualification. Premiums, cost of using mortgage loan insurance. This is, we're facing the actual cost here. So what does that cost look like? Some examples here just to really illustrate it, but I just do want to do a basic breakdown here. So when we go to the bottom portion over here, I don't have a laser pointer on this mouse, but up to including 95%. So what does that mean? That just means if you have 5% down payment, you're going to be paying 4% premium on your borrowed amount. So it's calculated one time. Just take your borrowed amount, your mortgage amount, 4% of that, that's what premium you would be paying one time. Now, when you do the math there, you're going to think, wow, I mean, $20,000, $30,000 one time to get in. It's a lot of money. It is one time. You can choose to pay it up front. Most people just put it back on the mortgage, but it seems a lot. I mean, $30,000 to get into a home versus saving 20% and just, not even having to worry about that kind of payment. I mean, it's a right way of thinking. It's really what's most important, to you is when you get into home faster rather than later. If we just look at an example of the down payment difference, it could be quite a bit. So really, the option is yours. Really, at the end of the day here, after our conversation, I'm not really trying to sell you anything. I'm really more so offering you door number 1, 20% down payment above, door number 2, under 20%. So scenario number 1, just a more real life example, or a more realistic example over here. If I have a purchase price around $800,000, the minimum that I would be needing to put down on this is $55,000. And I have the second set of highlighted numbers. $31,000 is what it's going to cost you. But that $31,000, of course, you don't have to pay up front. You can just put it back on top of the mortgage. So now number 2, if you decide to put 10% down payment, actually, you know what, I skipped a little bit ahead here because I did want to talk about this point. But when you have 5% down payment, you start at 4%. But if you put more down, so 10%, it scales down in terms of how much premium you would pay. So if you have 10% down payment, second set of numbers over here, you would pay 3.1%, and so on and so forth. So when we go to the scenario number 2, 10% down payment, again, that same $800,000 example, my 10%, $80,000, I paid $23,000 instead of $31,000. So big difference there. Really depends on what your situation is. So that's my portion for the mortgage loan insurance piece. Of course, I'm going to be sticking around for questions if you have anything, or you can just type it on the chat and I'm going to be happy to answer it. I'm going to pass it over to Evan for his last portion.
Thank you, William.
Thank you, William. Hi, everyone. My name's Evan Shapiro, and I'm a real estate lawyer. Thank you to the Zadegan team for putting this on and having me here tonight. Of course, they keep legal till last to put everyone to sleep as it's getting a bit later, but I'll try to keep it interesting. So, quick overview of what I wanted to chat about today. I'm going to talk to you about the closing process, the role of the lawyer. I'm sure many of you are wondering why you need a lawyer, so hopefully I can fill you in. About title and ownership, about understanding some of your closing costs,
the first-time buyer rebate, which has been brought up, some considerations when selecting a lawyer, and a quick checklist of things you should be doing when you're purchasing a home. So for the closing process, your journey will probably begin even before step one. You're going to sign a listing agreement, or rather a buyer rep agreement, and you're going to work with a realtor to find a suitable property. Once you do, you're going to negotiate an agreement of purchase and sale. There may be conditions in that agreement, such as financing or an inspection, or if you're buying a condo, a status certificate that you may need to satisfy. Typically, I get involved at steps 2 and 3, sometimes 1 if there's questions, legal questions about the agreement, but I would get involved perhaps to help with conditions, or certainly at step 3 to do a title search and do legal due diligence. We want to make sure the property you're purchasing is sound, that there's no legal liability or other risk you may incur. Mortgage will be arranged and mortgage instructions will be sent to your lawyer. We actually, for most conventional mortgages, we act for both sides. We act for the borrower and we act for the lender for the purpose of registration. If you go to a private mortgage, that lender may have their own lawyer, but for traditional mortgages, we would act for both sides. Lawyers prepare all the closing documents, the purchase documents, the mortgage documents. We get everything ready to meet you and sign you up on all those documents. We also handle all the closing funds. You're going to deliver the funds to our office, and we're in turn going to disperse them as needed, pay the seller what's owing, pay any taxes and closing costs. And finally, we attend to closing. We register and make sure you get good ownership of the property. The role of the lawyer, some things that we're doing for you. We're going to review the agreement of purchase and sale. I use an acronym APS. This is particularly important for pre-construction, especially condo pre-construction, as there's a 10-day cooling off period. We'll review the status certificate. Again, that's for condos only. A status certificate, just briefly, it's required by the Condominium Act. It gives important information about the condominium unit you're purchasing, as well as the building. It confirms your maintenance fees, that there's no arrears owing by the unit, whether there's any financial issues, special assessments, lawsuits against the condo corporation, any restrictions on important items like pets or smoking or leases that people may be interested in. We do a title search. We want to make sure title is free and clear, a term used to describe when there's no encumbrances, liens against the property that may affect your ownership. We will arrange title insurance for you, which I'll address in another slide. Prepare the documents, prepare the financial documents, and meet with you for signing. We'll receive your money, disperse it, I mentioned. We'll help you with your first-time buyer land transfer tax rebate. We register the transfer of ownership and mortgage. We hold all closing deliveries in trust and in escrow. We facilitate the closing process. We protect your interest in the deal. There may be certain terms, such as the seller is required to give a buyer a survey. We're the ones who would enforce that term to make sure you get exactly what the seller promised. On occasion, there could be a closing issue. We'll help you navigate it. We've seen all types of issues in our experience. I'd like to say there's nothing new, but there's always surprises. And we report to you. We'll give you a summary of the deal. Title. Title is referring to your ownership. And one of our jobs is to search title. And we do that to verify the identity of the current owner. And we want to match that with the agreement of purchase and sale, that the party you believe you're buying from is the party registered on title. We want to verify all current mortgages and liens against the property, because part of our job is to make sure those get removed, that you get title free and clear of any mortgages and liens. We'll also verify if there's any other registrations you should be aware about, easements, rights of way, things that may affect your use of the property. I'll also mention there's a public registry of all property records that's maintained by the Land Registry Office for Ontario. Each jurisdiction has a separate office, so these are public records. When you purchase a property, there's different capacities in which you could take title. If you're just a single person buying a property, you don't have much to worry about. But if you're buying with someone else, you need to consider whether you want to be registered and take title as joint tenants or tenants in common. Don't let the word tenant throw you off. You're not leasing the property. These are just legal terms. Joint tenant means you jointly own the entire property, and it has a special right of survivorship. And in comparison, tenant in common, we can split up ownership. We could say person A has 30%, person B has 70%, and there's no right of survivorship. The right of survivorship refers to what happens when one of the parties passes away. It's not a pleasant conversation. We're now bringing in an element of estate planning, but with joint tenancy, there's a right of survivorship, meaning if one party passes away, it goes to the other automatically. And the other way around, tenant in common, there's no right of survivorship. It does not go to the other party automatically. It would go to their estate. This is more of a technical issue. I'm happy to chat offline about it if you have questions about taking ownership. Title insurance, in the interest of time, I'm just going to gloss over this. It's a product that complements the services of the lawyer. It's a one-time payment you pay at the time of acquiring your property, and it has a whole range of insurance coverage. For your purpose today, I think it's just important to know that it exists, and it's something that I or your closing lawyer will explain to you in greater detail. Understanding your closing costs. This could be daunting, whether you're a first-time buyer, whether you're experienced. People want to know, how much is it going to cost to buy the property? What can I expect? There's going to be two main documents you receive from your lawyer. One is called a statement of adjustments. One is called a trust ledger. The statement of adjustments is between the buyer and seller. It will have readjustments for certain prepaid or unpaid expenses, such as property taxes or condo maintenance fees. And at the bottom line, we're going to determine what is still owing to the seller, taking into account all of these adjustments. I think the best way to visualize this is an example. So if I go to the next screen, you'll see here, there's a column on the far right, credit to vendor, which is another term for seller, and to the left, credit for purchaser, the buyer. The seller gets a credit for the sale price, of course. In this case, the sale price is $720,000. To the left, the buyer gets a credit for their deposit paid to date, $35,000. There's an adjustment for property taxes, realty taxes just below. And you'll see the breakdown of the calculation on the left-hand side. We take what was the taxes owing on the last bill, we estimate an increase for the rest of the year, and we estimate the property taxes for the year of your closing. We determine what portion has the seller paid and their pro rata portion for how many days they had ownership of the property. In this case, my example, we said they had paid $1,079, but they only owned the property for 50 days. Their share of taxes would be $607. So they've overpaid by about $471. The buyer would give the seller a credit in that amount in this case. Many clients, whether again, first time or it's your multiple time buying a property, they always have this misconception, I need to buy and sell the last day of the month to keep it clean. We can close any day of the month. It's really not relevant to us. I appreciate if you're renting somewhere, you want to time it, and that's a different consideration. But if there's any overpayment of property taxes, common expenses for condos, we would just adjust at the lawyer level. We get to back to our ledger, the balance due on closing. So taking into account the sale price, deposit, and the one adjustment, the buyer in this case still owes $685,471. That will take us to the trust ledger. The trust ledger is a different financial document which will record money coming into and out of our trust account on behalf of our client. In terms of incoming funds, we have your mortgage and the balance owed by the buyer to complete closing. And in terms of outgoing funds, we have the balance owed to the seller, land transfer tax, title insurance, and legal fees and disbursements. Again, a visualization will help. So far right side is money coming in, and just to the left, money going out. In this case, we received a mortgage from TD Bank at $575,700, and we've received from the client $123,376. We are basically plugging for that amount of $123,000, taking into account all the outgoing money. And I'll show you on the other side of the ledger. So we have paid to the seller the balance owed of $685,000. That's from the statement of adjustments, which we just went over. We have paid legal fees, disbursements, land transfer tax, registration fees, and title insurance. So if I add up everything there, we need to collect and pay out $699,076.01. On the other side of the ledger, I know I received $575,700 from TD. I plug for the difference, which is $123,376. Keep in mind as well, this contemplates that the buyer already paid $35,000 deposit. That's factored into the balance due to the seller. So again, lawyer role when it comes to financials, we're the ones who are going to calculate the amount owing, and we're the one collecting all the money, and we're going to be distributing it to all the parties. Speaking of costs, taxes, and the foreign buyer ban, there's a couple taxes buyers should be aware about. There's land transfer tax, vacant home tax, non-resident speculation tax, and while not a tax, another issue, the foreign buyer ban. Very quickly, land transfer tax is applied against a buyer whenever they acquire an interest in land. There's an Ontario tax and a City of Toronto tax. Other jurisdictions do not have land transfer tax. We would calculate the tax owing, collect it, and pay it to the right authority. If you have questions about what land transfer tax would apply to your purchase, there's many calculators out there on the internet that can give you a quick answer. Vacant home tax was introduced by City of Toronto a couple of years ago. Basically, if you buy a home, someone needs to live in it, whether yourself or a family member or a tenant, someone needs to live in the home for at least 6 months. Otherwise, it's considered vacant and there would be a tax applied by the City of Toronto. Right now, other jurisdictions are considering adding a vacant home tax, but Toronto is the main jurisdiction to worry about. Non-resident speculation tax, again, introduced a number of years ago. It would be a tax on non-residents purchasing property in Ontario, currently at 25%. It's not as relevant as it once was because of the introduction of the foreign buyer ban, which was implemented by the federal government about 2.5 years ago, which says any non-Canadian is not permitted to buy real estate in Canada. There are exemptions to both the non-resident speculation tax as well as the foreign buyer ban. If that may apply to your situation, I'm happy to chat with you offline, but these are all considerations. Speaking of the first-time buyer rebate, again, to put things into context, the provincial rebate is up to $4,000, municipal for Toronto up to $4,475. So about $8,500 max if you qualify. To qualify, Ari already spoke about some of the conditions, but they're up on the screen. Basically, you can never have owned a home anywhere in the world. And if your spouse has, you may also be disqualified. Now, speaking of the role of the lawyer and you're going to work with a lawyer, what should you consider when selecting a lawyer? You want to work with someone who specializes in real estate, which as well would tie into the next point, someone who's real estate insured. Lawyers have to have special insurance for real estate transactions. If you practice in other areas such as family law, criminal law, that's entirely separate. You wouldn't have real estate insurance. Furthermore, you want a specialist, someone who practices real estate, knows the issues, knows the industry to help on your closing. You want to work with a lawyer in good standing, goes without saying. You can look up on the Law Society website. Oftentimes, people get referrals from family, friends, and other professionals. I know if I need help finding a mortgage broker, an insurance broker, I speak to my network and see who they recommend. You want to have transparency on fees and the process. Lawyers quote in different ways. Sometimes it's an all-in fee. Sometimes it's a fee plus disbursements. You want to understand the costs. And if you're interviewing lawyers, you want to be able to compare apples to apples. You want someone who has knowledge and experience in the industry. Our firm has over 40 years of experience, myself over 13 at this point, and we've seen buyer market, seller market, and oftentimes when it switches from one to the other, there could be challenges in terms of closing deals. So we have a wealth of experience in doing real estate transactions. Like I tell my staff and other lawyers in the firm, at the end of the day, we may be practicing law, but this is a service business. You want someone who understands the customer service side that can not only handle the legal aspects, but that you're a client and you're getting high quality service. Someone who's communicating to you in a timely manner, in a manner that you understand, not just using legal jargon that doesn't make sense. I always try to take time to explain to my clients in a simple manner everything they need to know about the transaction. Finally, a buyer checklist, things you should be working on as you prepare for closing. You're going to satisfy all the conditions in your deal, finalize your mortgage. You're going to obtain property insurance. You're going to set up any utility accounts or rental accounts. Sometimes you're buying included in your purchase, you're getting a rental heater or water tank or other equipment. You may have to take over a rental contract. If you're buying a condominium unit, there may be special forms to fill out, such as an owner form, occupant form, pre-authorization form for payments. You're going to have to start preparing closing funds. You may have in different accounts, maybe even overseas. You have to get those ready and arrange a mover to facilitate your move-in. And a pro tip, I tell all my clients, do not schedule your mover for 9 a.m. on the day of closing. The buyer, seller, both of you have until 5, even 6 p.m. to close. And sometimes it may take until 5 or 6 to close. So don't be, schedule your mover accordingly. My last slide, just saying some of the work we do real estate, corporate commercial, purchase and sale of business, some wills and estates. But that's it. I'll stick around now for any questions.
Amazing. Thank you guys, everyone, so much. We're going to open up the floor a little bit now. If you guys had any questions, if you don't think of any right now, by all means, you know where to reach us. Feel free. We're happy to chat offline. And if you wanted the contact info for anyone that was on the panel, again, feel free to email us. We're happy to give that so you guys can have more detailed discussions on your case with everybody else. Amazing. If that is it, then we will let everyone know and bid you all a good night. Stay safe out there with the snow, and we are more than happy to chat with you guys on your individual cases, how we can best help navigating your first home purchase.
Amazing. Thank you so much. Thanks, everyone.
All the best.
Thanks a lot. Take care. Bye-bye.
Thank you, everyone. Bye-bye.
Thanks.